Ever feel like the deck is stacked against you when the market crashes? Like you're playing a game you can't win? Well, here's the truth. Market crashes aren't just the end of the line. They're a rare, golden opportunity. You see, while most people are paralyzed by fear, the few who understand how to navigate these stormy waters are quietly setting themselves up for financial success. Imagine making millions when everyone else is counting their losses. Sounds like a pipe dream, right? But it's not. The trick is knowing what to do and when to do it. In this video, we're going to unravel the mystery behind market crashes and show you exactly how to turn these turbulent times into your personal wealth-building playground. Ready to flip the script on financial fear and embrace a path to true financial freedom? Let's dive in. 1. Market crash history. When it comes to understanding market crashes, the history books have plenty of lessons to teach. There are three main types of market declines you should know about: market corrections, bear markets, and full-blown stock market collapses. Market corrections are like those minor hiccups, typically a 10% drop, that remind us the market isn't a straight line to wealth. Bear markets, on the other hand, with a 20% decline, are the times when even seasoned investors might feel the pinch. And then we have stock market collapses, where a 30% or more drop can shake even the most stoic among us. Recognizing these patterns can prepare you to ride out the storm rather than panic at the first sign of trouble. Think back to the 2008 financial crisis, a classic case of a market collapse. The housing market imploded, taking global markets down with it. But those who understood the cycle knew that it was a part of a larger pattern, something that's occurred throughout history. The dot-com bubble in 2000, Black Monday in 1987, these were not one-off events. They were part of a broader cycle that savvy investors prepare for. Understanding the history of these declines helps in not only predicting when the next downturn might come, but also in making strategic moves to safeguard and grow your financial freedom. Now, you might be wondering, how does this help me today? Well, knowing that market corrections, bear markets, and crashes are inevitable arms you with the knowledge to stay calm when others are losing their heads. Imagine the peace of mind that comes with knowing that your long-term financial success isn't derailed by a temporary drop in the market. Instead of panicking, you'll see these downturns as opportunities to buy assets at a discount, setting yourself up for wealth when the market recovers. 2. How to predict a crash. Every market crash follows a pattern, and once you recognize it, you can almost predict when the next one will hit. It all starts with the euphoria phase, where everyone seems convinced that the market will only go up. You see people pouring money into stocks, driving prices to sky-high levels. It's easy to get swept up in this excitement, but a savvy investor knows better. They recognize the signs: irrational exuberance, overvalued stocks, and a sense that nothing can go wrong. This is when it's time to start thinking about safeguarding your financial freedom by preparing for the inevitable downturn. As the euphoria phase reaches its peak, we enter the reckoning phase. This is where the market starts to crack under the pressure of its own success. Prices begin to fall, panic sets in, and suddenly everyone wants to sell. It's a harsh reality check, but it's also an opportunity for those who are prepared. Instead of selling in fear, consider buying. History shows that those who bought during the 2008 crash, or even during the dot-com bust, eventually saw tremendous financial success as the market recovered. It's about keeping a cool head and remembering that the market moves in cycles. Finally, after the dust settles, comes the recovery phase. The market stabilizes, and those who held on or bought during the downturn often come out on top. But to truly benefit from this phase, you must have the emotional discipline to stay the course during the downturn. Recognizing the three phases of a market crash, euphoria, reckoning, and recovery, can turn what seems like a financial disaster into an opportunity to build wealth and achieve long-term financial freedom. 3. The euphoria phase. The euphoria phase is like a party where everyone thinks the good times will never end. Stocks are soaring, and people are making money hand over fist, often with little regard for the risks. It's easy to get caught up in the excitement, thinking that financial success is just around the corner. But here's the thing. This is exactly when you should be most cautious. A seasoned investor knows that when everyone is buying, it might be time to start selling, or at least preparing for a downturn. After all, no market high lasts forever. During this phase, smart investors start to minimize their risks. They might reduce their leverage, meaning they're not borrowing as much to invest, and they save extra cash as a safety net. Diversification becomes the name of the game, spreading investments across various assets to protect against the inevitable crash. It's not about being pessimistic, it's about being prepared. Remember, it's much easier to safeguard your wealth when you've already taken steps to protect it before the market turns. Imagine this. While others are buying into the hype, you're quietly setting up your portfolio to weather the storm. You're holding on to cash, maybe even selling off some overvalued assets, and looking for opportunities to invest when prices drop. This kind of foresight not only protects your wealth, but also sets you up for financial freedom when the market corrects itself. The euphoria phase is a reminder that what goes up must eventually come down, and those who prepare are the ones who thrive in the long run. 4. The reckoning phase. When the reckoning phase hits, it's like the party's over and the hangover sets in. The market starts to tumble, and panic spreads as investors rush to sell. This is the phase where fear takes over, and you'll see headlines predicting doom and gloom. But here's the truth. This is also when some of the greatest opportunities for wealth creation present themselves. If you believe in the strength of your investments, this is the time to hold firm. History has shown us that those who stay the course often come out stronger on the other side. Take the story of Warren Buffett during the 2008 financial crisis. While others were selling in a panic, he was buying. He understood that the market would eventually recover. And by purchasing undervalued assets, he set himself up for immense financial success when the market bounced back. This is the mindset you need during the reckoning phase. Instead of letting fear dictate your actions, focus on the long-term potential of your investments, and consider this an opportunity to buy quality assets at a discount. However, it's easier said than done to keep your emotions in check when everyone around you is panicking. That's why having a plan in place before the market starts to decline is crucial. Decide in advance what you'll do during a downturn, whether it's holding, selling, or buying more, and stick to that plan. This kind of discipline can help you maintain your financial freedom even when the market seems to be falling apart. The reckoning phase is tough, but with the right approach, it can be the catalyst for significant wealth building. 5. Behavioral finance insights. When markets crash, it's not just the numbers that tumble. It's our emotions too. Behavioral finance shows us that cognitive biases like loss aversion and herd mentality can cloud our judgment at the worst possible times. Loss aversion makes the pain of losing money feel twice as bad as the joy of gaining it, which is why so many people sell in a panic when prices drop. They see their wealth shrinking and instinctively want to stop the bleeding. But here's the kicker. Selling at the bottom locks in those losses, robbing you of the chance to recover when the market rebounds. Herd mentality is another tricky beast. When everyone else is selling, it's incredibly tempting to follow the crowd. After all, there's safety in numbers, right? Wrong. Following the herd can lead you straight into financial disaster. Think about the dot-com bubble. Investors piled into tech stocks because everyone else was doing it, only to watch their wealth evaporate when the bubble burst. The key to financial success during a market crash is to recognize these biases and avoid making decisions based on fear or what others are doing. So, how do you fight back against these biases? Start by setting clear, rational rules for yourself before the market takes a dive. Decide how much you're willing to lose before you sell, or commit to buying when prices hit a certain low. And most importantly, remind yourself that market downturns are temporary. By staying the course and making decisions based on logic rather than emotion, you can protect your financial freedom and set yourself up for long-term wealth. 6. Emotional discipline. Emotional discipline is the unsung hero of investing. It's one thing to know what to do during a market crash, but it's another thing entirely to keep your cool when the storm hits. When prices start plummeting, your gut might scream at you to sell, to do something, anything, to stop the losses. But this is where emotional discipline comes into play. By setting predetermined rules for your investments, like deciding in advance when to buy or sell, you can take the emotion out of the equation. This helps you stay on the path to financial freedom, even when the market is anything but stable. One powerful technique for maintaining emotional discipline is practicing mindfulness. By staying present and not letting your mind race with worst-case scenarios, you can reduce the anxiety that often leads to rash decisions. Another strategy is to focus on the long-term picture. Remember, wealth isn't built overnight. It's the result of consistent, disciplined investing over time. This perspective can help you resist the urge to react to every market fluctuation and instead stay committed to your financial goals. Let's take a page from Ray Dalio's playbook. Dalio, one of the world's most successful investors, emphasizes the importance of sticking to a well-thought-out plan, especially during volatile times. He believes that emotional discipline is key to navigating market downturns and emerging stronger. So, the next time the market takes a dive, take a deep breath, revisit your plan, and trust in the process. With emotional discipline, you're not just surviving the crash, you're setting yourself up for long-term financial success. 7. The importance of a long-term perspective. One of the most valuable lessons in investing is the importance of a long-term perspective. When the market is in turmoil, it's easy to get caught up in the day-to-day fluctuations and lose sight of your bigger financial goals. But remember, wealth isn't built on short-term gains. It's the result of steady, patient investing over time. Those who achieve true financial success understand that the market's ups and downs are just part of the journey. By keeping your eyes on the horizon and not getting distracted by short-term noise, you can protect your financial freedom and steadily grow your wealth. Think about it this way. The stock market is like a roller coaster. There are exhilarating highs and stomach-churning lows, but as long as you stay on the ride, you'll eventually reach your destination. Historical data shows that despite temporary downturns, the market tends to recover and grow over the long haul. Investors who maintain a long-term outlook, even during the toughest market conditions, are often rewarded with significant gains. It's the patience to hold on to your investments during turbulent times that sets the stage for financial success. To put this into perspective, consider the example of the S&P 500. Over the last few decades, there have been multiple bear markets, but those who stayed invested saw their wealth multiply over time. If you had invested $10,000 in the S&P 500 in the early 1980s, you'd be sitting on hundreds of thousands today, despite the crashes along the way. This is why a long-term perspective is essential. It allows you to weather the storms and emerge with greater financial security and wealth. 8. Real-life examples. When it comes to navigating market crashes, nothing speaks louder than real-life examples of those who've weathered the storm and come out on top. Take Warren Buffett, for instance, often hailed as one of the greatest investors of all time. During the 2008 financial crisis, While many were panicking and selling off their stocks, Buffett saw an opportunity. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." By sticking to his principles and buying when others were selling, Buffett not only preserved his wealth, but also set himself up for massive financial success in the recovery that followed. Another powerful example is the legendary investor John Templeton. Back in 1939, as the world was on the brink of World War II, Templeton made a bold move. He bought $100 worth of every stock trading below $1 on the New York Stock Exchange, a decision many considered reckless at the time. Yet, his strategy paid off enormously as the market recovered, and those investments turned into a fortune. Templeton's story illustrates the importance of keeping a cool head during market downturns and trusting in a long-term strategy to achieve financial freedom. These stories aren't just tales of exceptional individuals. They're blueprints for how you can approach your own investments. By studying the actions of these financial giants, you can learn to navigate market crashes with confidence and patience. The next time you're tempted to sell in a panic, remember Buffett and Templeton. Use their examples as a reminder that market downturns, while challenging, are also opportunities to build wealth and secure your financial future. So, now that you're armed with the knowledge to turn a market crash into a wealth-building opportunity, what's your next move? Will you sit on the sidelines, watching as others seize the moment, or will you dive in, ready to take control of your financial future? Remember, the greatest fortunes are often built in the most challenging times. It's not about timing the market perfectly. It's about having the courage to act when others are paralyzed by fear. But before you go, ask yourself, are you truly prepared to make the most of the next market downturn? Have you set your financial plan in motion? If you're serious about achieving financial freedom, now is the time to take action. Subscribe to the channel, hit that notification bell, and stay tuned for more insights that will help you not just survive, but thrive in any market condition. The path to financial success is in your hands. Are you ready to walk it? See you soon!